Today is September 19th, 2024, and today we're going to be talking about the interest rate cut that happened yesterday. So the FOMC cut interest rates by 0.5%. Today, Wall Street celebrated, the Dow and the S&P 500 went to all-time highs again. So will the rally continue, or is it now a very good time to get defensive? And what about those pesky paper losses in our bond portfolio? Will lower interest rates help them to recover? Should you now consider buying a home with mortgage rates falling? Will that make it more affordable? Should you sell your home? Should you buy gold? Should you buy crypto? Should you stuff your money under the mattress with all the debt there is in the world? And what about the election? All this and more in today's free video conference. Remember, you can share it with your friends. It's a great idea to empower everyone around you to keep their wealth so that we can have greater and stronger friendships and partnerships. All right, I'll get started momentarily. So I think the headline here is real important. Like, what's the broad picture view? Why did the feds lower interest rates in the first place? Now, their dual mandate that they say all the time is price stability and maximum employment. So they've seen that they have brought the inflation down. It's at about 2.3% right now. So that's getting closer to where they want it to be. They want it to be at 2%. And what they have seen, which is the reason why they cut the interest rates, is they've seen unemployment has been ticking up. So they want to get ahead of that curve. Why? Because they want to prevent a recession. When we start seeing unemployment tick up, then we have people who can't afford to start paying their bills. That means that all these companies in America that sell products to American consumers, they're going to start missing their earnings reports. We will then slide into a recession. Okay, things are looking great right now, and no one is predicting a recession. So, in other words, they want to be ahead of the curve. Now, I have to give a caveat here. Economists are terrible at predicting recessions. In fact, I have a little couple of charts that can kind of show that to you. I'm going to pull them up. The first thing I'm going to show you is I'm going to show you that I have updated the ABCs of Money. We have the 6th edition out now. In anticipation of the rate cutting cycle, I thought it was important to update. So I do strongly recommend that you get this. Be sure you get the 6th edition. All of the things that I'm talking about are covered with this fresh perspective folded in, written into it. So that's something that you want to look at. But with regard to, how well economists predict recessions. So again, I issued the recession warning before the Great Recession. This is not what the feds were issuing. They were denying that we were in trouble until they had the TARP money. That was October of 2008. And the NBER did not say we were in a recession until December 8th of 2008. So you got the warning at the beginning of 2008, and it wasn't announced until the end. And you can see here that stocks dropped about 40% before you got the notice that we were actually in that pretty steep recession. And by the way, it was even worse during the dot-com recession. That when we were telling people in Christmas of 1999 that they should be more defensive and start capturing the gains on all the money they made on dot-com stocks. Between March 2000 and the low in October of 2002, the NASDAQ fell 78%. It took 16 years to come back to even. But as you can see here, most of the losses occurred even before 9/11. And the recession announcement didn't come until November of 2001. We were warning people basically Christmas 1999, or in other words, at the top in January, March of 2000. So again, economists don't have a great track record at predicting recessions. So right now, actually, we've done much better than we anticipated. We actually did expect a recession to occur in 2022 when the interest rates were being, hiked up so rapidly. All right, so let's talk about what this means for you. I think what it means for you is that you want to look at the pluses and minuses, the upsides and downsides of all of the assets that you might have. So stocks, as an example, are at an all-time high. We are not predicting a recession, but we are seeing unemployment start to go up. There certainly is some problem in this commercial real estate is one problem. Long-term bonds, we'll talk about the pesky paper losses in just a moment. Those are a problem, and they're not just a problem for the companies and the individuals who invested in those long-term bonds, but also for, let's say, insurance providers, because they have a lot of exposure there as well. So these are all things that you want to be ahead of the game. Remember, if you fix the roof while the sun is still shining, your financial house can withstand economic storms. It's human nature to fix things when they break. And that can be a problem. I just showed you a chart of how long it took for dot-coms to recover, 16 years. So it's a much better idea to have a plan that's diversified, that is protecting you, that is age appropriate, and that avoids those pesky paper losses in bonds, because those are actually a much bigger problem than people realize. That means your FICO score goes down. That means that you don't have the liquidity if you need to buy something. If you actually are get into trouble and you have to sell, you lock in those losses. It's no longer a paper loss, it's a realized loss. So liquidity is going to be an important part of the strategy going forward. It has a lot to do with real estate being at an all-time high and stocks is an all-time high. So rather than just hoping and praying that everything keeps going higher and higher and higher and higher, even though we do, I mean, I don't have yet to meet one American, probably any global citizen, honestly, who isn't a little bit concerned about the amount of debt, not just in our country, but in the entire world. So what do you do about that? Well, the first thing you do is you want to keep a percent equal to your age safe. And you want to make sure that that's not going to be vulnerable to paper losses. So be careful about reaching for yield. This is so tricky right now that we actually are going to host a bond masterclass. It's going to be the Saturday after our financial freedom retreat, October 26th. If you are over the age of 45, you should definitely consider investing in the life math that allows you to be the boss of your money. Because I do second opinions. I'm unbiased because I don't sell you financial products. And what I see is that what people think they have is very different from what they do have. So it's a really good idea for you to know what you want to be the boss of your money and make sure that your plan is set up to properly protect you and also to participate when Wall Street goes up, and especially in AI and NVIDIA. That is easy as a pie chart once you learn the life math that we all should have received in high school and college. So again, I do encourage you also to consider our Financial Freedom Retreat, October 18th through 20th, and the Bond Masterclass the Saturday after. If you bundle them, we'll give you a $100 discount, and we'll give you access to our Real Estate Masterclass that just happened a few months ago. So again, if you want to read about it, the ABCs of Money 6th edition, if you want to make sure that you are properly set up, even before the election, then attend our mid-October retreat and the What's Safe Masterclass, October 26th. Okay, so in general, what do I think is the upside downside in stocks? Look, stocks can keep going up, and then they silently creep down. Usually it happens according to what I call a series of unfortunate events. So if we take a look at the Great Recession as an example, right? What happened was we started seeing a lot of mortgage banks go under or get absorbed by banks. Countrywide Financial, but there were a bunch of that got absorbed by Bank of America, but a bunch of other ones actually failed and went out of business. Okay, so we started seeing that in 2007, and I started saying, look, there's a little bit of a problem here. Then by December of 2007 and certainly January 2008, I was saying this is going to be a massive problem. Overweight, 20% safe. Now, because of elevated prices in stocks and also elevated prices in debt and leverage, we are overweighting 20% safe in our sample pie charts right now. So that means that you could act a little bit older than you are. What's the benefit of that? If stocks drop by half and you're overweighting safe, let's say you're 50, you're overweight 70% safe, Instead of losing half of your portfolio, you only had 30% in stocks, right? If that goes down by half, that's a 15% loss. And if you are able to make some income on the safe side, then that might offset that completely. We saw that happening in the Great Recession and the dot-com recession. Those people that used our strategies earned gains instead of losing half or more of their wealth. So this is a simple no-brainer. Then how do we get into bonds? Well, you want to, in my view, keep the credit worthiness high because there's way too much debt, and you want to keep the terms relatively short. So the real losses are happening in long-term bonds. So let's take a quick look. They're also illiquid. That means that, those paper losses may not be as paper as you realize because liquidity is such a concern. So here is, I have it here. Here is the average liquidity data. This is from today. So as you can see here, UK gilts, which are, they're very similar to US Treasury bills, very illiquid. We saw a UK gilt crisis that actually got, Liz Truss fired from her job as prime minister rapidly. So that can happen. You can also see here that corporate bonds are also very illiquid. I'm sorry that these words are so tiny. You can also see that the Dow Jones Industrial Average is not that liquid, especially compared to the S&P 500, which is the most liquid. Then gold and US T-bills that are not the long-term ones are fairly liquid. Now, I also want to show you where things stand. So as you can see, last year, large cap stocks, mainly the Magnificent Seven, did great, right? Small caps didn't do as well, but they did pretty darn good. And long-term government bonds, they only came up 2%. This is a big problem because in 2022, long-term government bonds lost 26% of their value. So they haven't recovered. The paper losses are still there, and there is still a lot of credit risk and duration risk. So keep the term short, the credit worthiness high. There's actually low-hanging fruit for a lot of people on the best performing bond that is actually the safest. And we do talk about some of those ways that you can look at those in the bond masterclass. So if that's of interest to you, definitely consider that. What about real estate? Real estate can lose value in recessions as well, right? Because especially when you have a debt world like we have today, because people can't afford to pay their mortgage. And so real estate prices can drop. So between the high of 2006, that was the high before the Great Recession started. But of course, real estate was one of the big problems in the Great Recession. To the low of 2011, nationwide, real estate prices dropped 25%. Of course, if you were in those ground zero cities, Detroit, Phoenix, Stockton, California, Miami, there were a few of them where they dropped much, much more than that. So what I would say is this, what we have seen is that sadly, 82% of purchasers last year and this year in real estate have buyer's remorse in a big way. Many of them are struggling to make their mortgages. Some of them are saying, hey, they're having to take on debt to maintain their similar lifestyle. So what I would say is this, you don't want to do the simple math. You don't want to just say, oh, it would be cheaper, my mortgage would be cheaper than my rent. First of all, that is excluding a lot of costs of homeownership, property taxes, insurance, maintenance, closing costs, a lot of things, right? But also, if the value drops and all of a sudden your mortgage is more than the value, your FICO score goes in the toilet and everything becomes much harder. So this is not don't do the simple math and then get yourself in trouble for the next decade. There's an entire real estate section in the ABCs of Money 6th edition. You can read that. There are many case studies. I've helped people now since 1999. So we have anonymous, a lot of different examples for you to be considering and to kind of push you up the path to wisdom a little bit on this. In terms of gold and crypto, so crypto goes on its own little wild ride occasionally, right? Like 2017, super high, 2018, crypto winter. These kinds of things occur. But what is also important to know is that when stocks go down, it does initially start to drag down crypto and gold. And then there is a decoupling where they can both be what we would consider emotional choices. People consider them to be a safe haven. I wouldn't call them a safe haven because you can't have something that's safe that can lose the amount of value that they can, right? So, we've seen such wild swings, like even gold. Its high was in 2011. It was up to almost 1900 an ounce. And then it dropped over the next few years down in the, 12, 1300 an ounce range. So now it's up higher, but that's a long time to have losses. And people, go into these safe havens, they push in way too much of their wealth. So again, it's all a matter of proper diversification, and liquidity is going to be important. And also making sure that you don't lose a lot, because everything can go down in a recession. Now, is there a recession predicted? No. Can a recession happen? Yes, absolutely. And what we're going to be watching is the unemployment rate, the commercial real estate market, and also the financials. So insurance companies, banks, brokerages that have exposure, especially to long-term government bonds and long-term corporate bonds. So you need to also, in my view, make sure that the company you purchase your funds from, it has a high credit rating. Maybe bank with a high credit rating of a bank. Definitely on the brokerage side, I would go with a high credit rating. And also on the insurance company and money market funds and all these other things, even fintechs, companies like Square, PayPal, they are fintechs. They're not banks. So, your cash there is not FDIC insured. And they have it in the fine print because they'll tell you, oh, we have an agreement with a bank and they will FDIC insure your cash. But now they've gotten a lot more explicit about spelling out to you that there is actually a loophole / sinkhole, because if they fail, it's not FDIC insured. So there's a little bit of a caveat in the fine print there. And that brings me to the final thing. So get safe, hot, protected, diversified, know what you own, be the boss of your money. If you get losses there, it's not like your broker loses, and it's also not like they can recover those. You're going to have to wait for the asset to recover, just like those pesky paper losses that have shown up in your portfolio. 26% on average losses in long-term government bonds in 2022, and they only recovered 2% of that in 2023. This is still a problem because of the amount of debt out there, right? So you really have to be observant about creditworthiness. Don't reach for yield and keep the term short. All right, so join me at my October 18th through 2024 Financial Freedom Retreat. Join me for the What's Safe Bond and What's Safe Masterclass the Saturday after. All of this happens before the election, so you can really batten down the hatches in case there's any volatility before, after, or during the election. Okay. And remember, you can always watch this back at youtube.com/Natalie Pace. Now, also, one final reminder is that when you are looking for the ABCs of Money, 6th edition, the best way is just go to nataliepace.com. You'll see the book cover, click on that. That way you get the 6th edition and not the 1st or 2nd or 3rd or 4th or 5th. Also, if you go to nataliepace.com and scroll down, you'll see the Financial Freedom Retreat. You'll also be able to find out more about our Bond Masterclass in the menu. Just scroll down to the Bond Masterclass. And all of these links are going to be in the description of the on the YouTube channel, youtube.com/Natalie Pace. So thank you so much for joining me. I look forward to seeing you at the October retreat. Let's make sure that you're the boss of your money, that you protect your wealth, and yeah, you're going to be happy you did. When we finally hit a recession, they're part of a normal business cycle. Again, it's not predicted to happen soon or even this year or even next year. Nobody's predicting it. But as unemployment rises and they have to start cutting rates, that is to try to stave off a recession. That's really why they do it. All right, thanks again. Remember, nataliepace.com email us at info@nataliepace.com and we're happy to help you solve your money problems, challenges. Right now, again, the economy is pretty strong with stocks high and real estate high. So now is the time when you want to do all of this. You want to really batten down the hatches and protect your wealth. All right, thanks again.